Good morning, everyone, or good afternoon, everyone. Thank you for joining us today. A few housekeeping items before we get started. Folks in the audience, you're in listen-only mode. So if you have any questions or comments, feel free to type them into the question or chat sections respectively. We will take some time to answer any questions you may have after the presentation. For those seeking CE credit, please focus your attention to today's presentation and answer the polling questions in the presentation in order to earn credit. Without further ado, I will turn over the microphone to Ron Calcerano, our Maryland State Manager.
Hello, everyone. Welcome, and thank you for joining us today on our webinar. Excuse me for not being visible. My webcam is acting up. I apologize for that. I'd like to introduce Bill Horan from Realty Exchange Corporation. He will be handling our 1031 exchange webinar today. Bill's very knowledgeable. I'm sure you'll all get quite a bit of information out of this, and I hope you enjoy it. So without further ado, Bill, take it over.
Cool. Thank you, everybody. Thanks for coming and attending today. We're going to talk about 1031 exchanges today. I mean, what is this all about? We are going to talk about some boring stuff like math and taxes and legal stuff, but really you can't remember, don't lose focus. This is really all about money. That's what this is about. So an investor is taking a rental property, land, commercial, whatever the heck it is, and trading it for different property. And and they don't have to pay tax to get from A to B. And I'm gonna talk about that. And what is this all about, and what are all the mechanics to do that, right? Sale of a profitable real estate will be taxed. I think everybody understands that, right? So Uncle Sam is, sometimes I use the term, they're your partner in the investment deal, whether you want them there or not, but they're gonna get a cut when you cash out and sell the property. So they're willing to go with you on to the next deal. And there's a set of rules around getting from A to B, and that's what we're gonna cover today. Here's what I am gonna try and do quickly for you, right? Who I am, why you should or should not listen to me. What is an exchange? Where does it come from? What is the definition of like kind? You'll hear that term, like kind exchange. What does that mean? What is the timing and identification step for an exchange? Because the government doesn't let you just sell something and think about buying something new in the future. You got to do it in a certain window of time. How much you have to buy to not pay tax? The role of a qualified intermediary, the middleman that sets up exchanges, and that's what I am. I'm a qualified intermediary. Talk about process paperwork. I am going to touch on reverses where we do them backwards, and a little bit about other things that I see clients doing. How are they using 1031? So I got a lot to cover here in just a short window of time. My dad started our company in 1990. So our little business is 31 years old. I'm 19 years doing this. So this is all we do. There's 14 of us here. I'm in Gainesville, Virginia, so I'm in the DC area. And this is all we do. We help clients do exchanges all over the country. Dad wrote a book. It's up on Amazon. He actually wrote a second version of the book. He is 90. He rewrote it while he's sitting in his assisted living place, all on his own. The book has a few typos in it, but God bless him, he rewrote his book at 90 years old. We're members of FEA, Federation of Exchange Accommodators, which is our association for qualified intermediary companies like myself. And we spend a good bit of our time working on things on the Hill and things like that. It's part of our process of dealing with threats from Capitol Hill. I was part of a team that got law passed in Virginia on qualified intermediaries. There's only a handful of states in the country that have law on 1031 exchange companies like myself. Massachusetts is the other one here on the East Coast. Let me just talk about this for a minute because this is what everybody's watching at the moment. Capitol Hill, obviously there's a lot of activity going on Capitol Hill. During the campaign, President Biden had proposed killing 1031 exchanges. And then when the bill actually came out, when he made his proposal, he was putting a cap of $500,000 per person on there. So all we had was a paragraph, so there wasn't a lot of details, and there was a million questions in there. There is a gigantic coalition of associations that are opposed to this and have been lobbying very heavily to leave 1031 exchange alone. American Land Title Association, National Association of Realtors, forestry people, ag people, hotels, all these guys are jumping in to leave 1031 alone. Just as a little bit of inside ballpark, inside baseball for you guys, The initial feedback we're getting that both the Senate and the House bills do not have the 1031 cap in it. The sausage is being made at this moment as we speak, so it's still a little early to, I'm going to use the word declare victory, but we're feeling pretty good at the moment that they listened to us on Capitol Hill to leave 1031 out of these proposals. But it's not done till, what do they say? Not done till till it's done, right? But we're watching it very, very closely. I'm part of our lobbying team on Capitol Hill to protect 1031. We do an awful lot of lobbying with members and senators and communicate with them. You know, they use the term loophole. It's not a loophole, it's part of our tax code. And so it's a lot of it's education on our part. So let me press on for that, because we're feeling pretty good that we're not being swept up in this tax reform stuff that's coming out of Capitol Hill, right, as a pay for. What if you could help us, that would really help. You know, we have a grassroots thing that's going right now. That website right there, it's one of those where you click in and put in your address and everything, and they'll send letters to your members of Congress. So that would help us a lot. You guys have been involved in grassroots things. Squeaky wheel gets the grease, and it works. And so we've been pretty active on this. Many, many thousands of letters have gone into Capitol Hill on this stuff. If you send a letter, just inside baseball, you send a letter to Capitol Hill, like the old physical kind with a stamp on it, it rarely gets there because it goes through so much security. Everything gets really slow to do that. So everything's online now. Anyway, what is an exchange? Let me just define it just by pure definition. It allows a taxpayer to exchange an investment, rental, or business property and defer the payment on the capital gain. Normally, there's a delay between settlements of the property being given up, the relinquished, and replacement. Here's where it comes from. So this is in the law. This is not a program, not a scheme, or anything like that. No gain or loss shall be recognized on the exchange of real property held for productive use in trade or business or investment if such real property is exchanged solely for more real property, which is going to be continued to held as investment property. This definition is really a trade. Two people find each other and swap properties. That house on the left there, that's a big old residential rental property, and that Hardee's is down in Franklin, Virginia. It's west of Norfolk, down in Southern Virginia. These two guys find each other on Craigslist. They like each other's properties. They trade deeds. That is an exchange by definition. That is a pure simultaneous exchange. We used to do equipment exchanges, personal property exchanges. We were working with several construction companies where they were trading their big bulldozers and all kinds of stuff. We used to call it yellow iron. They would trade all that kinds of equipment, and those were all exchanges. With 2017 tax reform, when we went through it a number of years ago, we lost personal property exchanges. So today, it is only real property, and that I'm emphasizing the real word in there in red, because that's what 1031 is today, is only real property. It's none of that other stuff, no personal property before. It used to be about half the exchanges in the country were personal property. All kinds of stuff was exchanged, railroad cars, boats, airplanes, all kinds of stuff was exchanged, but now it's only real property, okay? A little bit of history. So you may have heard the term Starker exchanges. That comes from a court case. So he was in the timber business, and he owned a bunch of timberland, and he struck a couple of deals with some timber companies where he gave up his ownership of the timber, and then they replaced it later. So what the deal was, here, you can have my timber, and the timber companies promised to replace his real estate, right, his timber. And so they did that, a couple of transactions, and he turned it into the government as an exchange, and they denied him. He went to court, and he won in court. They challenged him a second time, and he won the second time. The key language in the legislative history was, is the taxpayer's money still tied up in the same kind of property? And the answer was yes for that. He had timber, and then later he got timber as replacement property. And he didn't gain in the middle. They didn't give him any money when they took over that first set of timber property from him. So he's the one that gave us the delay, where you sell property and then you end up getting replacement property later. So he's a key guy in the 1031 industry, okay? The government had to deal with that delay. So they gave us a regulation. A deferred exchange, a delayed exchange is defined as an exchange in which pursuant to an agreement. So Mr. Starker had an agreement with the timber companies. I have an exchange agreement with my clients. You can almost think of me as like the timber company, this middle person between the transactions of giving up the old and getting the new. The taxpayer transfers property held for productive use in trade or business or investment. That's the relinquished, the one you're giving up, and subsequently receives property also to be held. Okay, there's the sequence. Clients got to give up the old one and then get the new one in that order by law. Okay, so they can't go buy something new, sell, and buy from themselves because it doesn't work. The sequence is give up the old and then later get the replacement property. Most people need the money to get from A to B, okay? But it's got to be that way by law. So who is the middleman? So obviously this is government stuff, so they defined who the qualified intermediary is. It's a person who's not the taxpayer, meaning you can't do your own transaction, or a disqualified person, which really means agency. Anybody that's got agency with the client cannot play the role of qualified intermediary. Enters into a written agreement, like I mentioned, we have an exchange agreement, and as required by exchange agreement, acquires the relinquished property from the taxpayer. When the client signs up with me and I have my exchange agreement, they're giving me their property on paper for tax purposes. You got to remember, this is all made up by the government. This is a fig Newton of their imagination. Transfers the relinquished property. That's why we get the money from the closing. They've hired us. We're functionally now the owner of the relinquished property. Tell you guys to do settlement and everything comes to us because it's our job to do the transfer of the relinquished property. Acquires the replacement property. You got to remember, the sale happened, money came to us. We have the money. We step in and buy the replacement property for the client, and then we make sure that they are the owner when it's all said and done. So the client had property, they give it up to us and they don't get anything, right? No gain. And then we use their money to buy what they tell us to buy as their replacement property and make sure they're the owner. Just like Mr. Starker, he had property, he gave it up, but didn't get anything in the middle, and he still owns property when it's all said and done. There's just this gap in time between ownership. Okay, so mechanically, that's what's happening in these transactions. What we typically see, just so you have a feel for what this transaction looks like, there's a normal contract to sell, normal sales contract. A QI like myself gets hired before closing, and I'm assigned into that contract. So functionally, that's how I step into the transaction, is they're assigning me into the deal they already cut. And then I'm going to send settlement instructions to the title company, you guys, so that you know what to do. Hey, this is now an exchange. Send me the money and deed the property directly from my client to the buyer. We do not need to go on deed. It's not necessary, okay? Then the money comes to escrow to us, and the clock starts ticking. And then the client chooses and contracts for the replacement, just like normal. They go out and put a contract on something new, and we get assigned into that purchase contract. That's how we step into the deal that they cut. So functionally now we are the buyer, we have the money, we will send the money to closing on the new property, and we give you guys instructions, hey, please deed this property directly to my client as the buyer. And then it's done. So the sale happens and then a purchase, but it's all passing through us and the client isn't gaining anything in the middle. I hope that makes sense, right? So for the clients, it looks like a sale and a purchase, and the stranger is sitting in between, bridging them from the old to the new. We try and make it as streamlined as possible. Let's do math, right? I told you there were going to be some painful things here. Every client is making the decision, should they just sell it and cash out and pay their taxes, or should they do an exchange? And one of the first things you got to do is, what's my tax bill going to be? So let's do that math, right? So here's my scenario. I'm selling something worth $500,000, a rental townhouse or something. I had a basis of 150 when I first bought it. That's what I first bought it for. And I've taken 45,000 of depreciation. When you own a rental property, you get to depreciate it a little bit each year for wear and tear. And I owe 90 on the property. What I'm after is gain. What's the gain on this property, right? Every investment you have has a basis and a gain. So we're trying to calculate that gain. I got my sale price at $500,000. I estimate 8% to get out. commission, transfer taxes. There's a bunch of fees to get out. I estimate 8% because it's typically 6% commission and 2% for all the other fees, your guys' fee, transfer taxes, all those other things. So I'm guessing 40 grand to get out. Gives me that adjusted selling price of 460. I'm adjusting for those selling costs. My original cost was 150. I didn't do any improvements to this property, anything of value that improves the value of the property. Big things like a new roof, a new kitchen, those are improvements added to the property. I just did repairs to keep it alive, you know, patch the holes in the wall, fix the toilets, that kind of stuff. Those are annual expenses. Gives me an adjusted cost basis of 150 less the depreciation I took, right? So when you take depreciation, you're lowering your basis. So the tax basis when I sell is 105. The gain is the difference between that 460 because I adjusted for my selling cost and that 105 number. I got 355,000 of gain on the sale of this property. Okay, what's the tax due on that gain? The very first tax the government picks up is the recapture of depreciation. They let you take that paper loss every year, but when you cash out, you got to pay it back, and it's at a max 25%. Many clients are in the 24% bracket, income tax bracket, so that may be where the cap is, but the max is 25%. That's 11 grand, okay? That's the one most people miss. They don't understand. They got to pay back that depreciation that they took when they want to cash out of the business. The 310 is the profit because it went up in value from when I originally bought it at 150 grand. That's the appreciation. That's typically at 15% money, and I'm showing 46,500. We have a progressive tax system because the more you make, the more you pay. So we're about to put $355,000 on somebody's tax return. One of the other taxes that kick in is that 3.8% net investment income tax. That applies if net investment income, and this is investment income coming in, is above 200 for an individual, 250 for married. So this transaction is going to get hit with that extra 3.8%. Another tax that potentially kicks in is that when the capital gain, when your income climbs above 441, 500 single, 496 married, they're weird numbers because they're indexed for inflation now. The capital gain rate changes to 20%. That's a pretty high hurdle before it kicks in. My point of all of this is that when you put that much money on somebody's tax return, along with all their other income, they're rich for the year, whether they realized it or not. And so other things are going to kick in to that income tax return, and the tax bill is a little bit higher. So I'm showing 57,750 there. That's too low a number, right? Because these other things are going to kick in. I don't know if anybody's had to write a big check like that. I call that your pain number. Okay, you got to remember Maryland wants a piece of the action too, right? You make money in Maryland, you got to pay up in Maryland. I put 7% there. I realize every county's got a little bit different number in there. So, you know, I'm guesstimating 24, maybe 25 grand of Maryland income tax on top of the federal income tax. So here I am showing 82. I'll bet it's more like 95. By the time everything else ripples through the tax return, we're probably talking about 95 grand. God bless you if you want to just write the check to the government. I've never gotten a thank you note when I write a big check like that, but you know, that's how the process works. Or you keep that money and go buy another investment. Go try and make more money someplace else. Let's change this investment to a different one. Change the location, change the type, break it into multiple properties, whatever you want to do. You're functionally continuing your investment and moving it someplace else. Okay, and that's what I'm gonna start walking you through. Oh, I got a poll question.
We're at poll question 1. Thank you for that. I will go ahead and launch the first poll question. And folks in the audience, a 1031 exchange and one of three items, or one of three options: allows deferral of gain on investment real estate, or B, makes a gain disappear, or C, is a loophole. We'll give a few moments for the audience to cast their vote or respond. Alrighty, we've got almost all the votes in. I'm going to go ahead and close out the poll, and I'll share with you the results. 92%, the overwhelming majority, says allows a deferral of gain on investment real estate. Some of the audience did mention that it is a loophole.
And I battle that on Capitol Hill. We're not a loophole. Leave us alone. That's our message when we talk on Capitol Hill. Leave us alone. So that's cool. All right, let me press on here. What can you trade into? What's a criteria for an exchange? What is the definition of like kind? So the definition is real property for real property, as long as everything is held on your books as business investment. So I can go from raw dirt into a rental beach house, into a hotel, warehouse, mix and match all I want, as long as it's real property and it's all being held as business investment property. So it's a very broad definition of what you can replace the property with, okay? So like kind just means real property for real property as long as it's held for business investment, okay? Now, it's also the whole bundle of rights. So I did a transaction not too long ago for a cell tower easement. It's about an acre underneath the tower and the little road that ran up to it for timberland up in Maryland. So there's all kinds of the bundle of rights that are also exchanged. I've done density rights, development rights. If you're down in Oklahoma and Texas, you're doing oil and gas rights, mineral rights. It's a big deal. I finished a water rights transaction here not too long ago. A young lady owned the water rights on some property north of Denver. And then she took the money and bought a condo down in Fredericksburg, Virginia. So she went from these water rights, because she had sold the land years ago, but she kept the water rights and then finally sold the water rights. So that's a very large part of this business, is those mineral rights, all those kinds of rights are also exchanged, okay? I'll give you an example, like air rights in New York City is a big deal. You know, somebody sells the air above their building to the next door neighbor because he doesn't want anybody to build above him or whatever it is. So that's also part of this. Bulk of what we see is typical selling residential rentals and going to buy more residential rentals someplace else, a better investment, right? But it's a very broad definition. What does it not cover? So I'm going to come at it from a different direction. This is not about homes, right? This is not about primary residences. That's a different section of tax code, section 121. I'm not sure if everybody knows the basics on this. You can sell a primary every 2 years and exclude 250,000 of gain if you're single, $500,000 if you're married. So typically on a home sale, most people don't pay any income tax on their properties, okay? Second home vacation homes are not covered under 1031. Those are all personal use properties, right? This is about business investment properties, not personal use. When does a property tip over and become an investment property versus a second home? If personal use is more than the 14 days per year, or 10% of the days rented. So like somebody rents for 300 days, they could use it personally 30 days and they're okay. So that personal use is what taints a property, whether it becomes a second home or an investment property, okay? Dealer property is not exchangeable. What's a dealer? That's a builder, a developer. That's their whole business, is just buy stuff, add value to it and sell it. That's their intention. So just like Giant Food buys cans of tomato sauce and sells it, it's really considered inventory because that's their business. So the dealer property does not qualify for 1031 treatment because they're holding it for resale. They're not holding it for investment property. That's really where flippers fit, because that's their intention, right? They want to buy it, fix it up and sell it. God bless them, right? It's a good thing. But they really bump into the definition of 1031 as held for an investment. That gets very gray as to what are you, what business are you in? Because you can be in both businesses. You can be in the buy and hold business and you own a bunch of rentals, and you can be in the flipping business. Our cheap advice industry-wise is to run two businesses. I have an LLC that does the buy and hold business, and I have an LLC that does the flipping business, and keep the two away from each other. There's a court case sitting out there where a builder held raw land for 11 years, did an exchange on it, as I probably would have, thinking I'd held the stuff for 11 years. I should be able to trade my dirt. It went to court for some reason, and the judge got his books, and on his books it said work in progress. That's how he was holding it on his books. Judge said, nope, you're a dealer, no exchange for you. So you gotta be careful in that space. Partnership interests are also not exchangeable. So let me use an example. I decided to buy a beach house with my neighbor. The attorney told us to create an LLC and take title to the Ocean City beach house with an LLC. The partnership now owns the real estate. We're in business together. We created a partnership. I'm a member, he's a member. It files its own tax return, collects the rent, has its own books, etc. and everything passes through to us on a K1. But technically, we own an interest in a company, and the partnership itself is the owner of the real estate. The partnership can do an exchange, not the individual members of the partnership, because they don't own real estate. Typically, what we run into is the people don't want to be partners anymore. Well, I don't like my neighbor anymore. He was terrible with me. This is not a good partnership for us. But they don't want it, so they don't want to go together on the next deal. So we go through these exercises called drop and swap and swap and drop. And these really need to be planned out well in advance, because there's some risks that comes with it, because you're rejiggering the ownership before the sale of the property. But they're trying, people are trying to get into an ownership of real estate so they could do an exchange on it, okay? So you gotta be careful with that piece. And then property outside the US is not like kind. You'd be surprised how many calls I get. Somebody wants to sell their rental property and move the money into Costa Rica or some other country and not pay tax. And the government doesn't let you do that. You can actually trade foreign property for other foreign property. I just don't do those. They get very, very complicated. You know, where is the money? I can't read the contract because it's in a different language, all those sorts of issues. So I have to refer those off to somebody else to touch those. Anyway, let's talk about timing for a minute, right? So we talked about how much is the tax bill when you sell out. You know, that's a big number. We don't want to do that. So and now we know we can trade for any other kind of real estate we want anywhere in the country. So let's do this thing. The government gives you 180 days to trade the whole property for new, right? So that's the window of time to get this thing done. The reason we have 180 days is because the government wanted everything on the same tax return. So when you sell, like for example, you sell now in October, you may not be buying until January, February of next year, but everything gets reported on this year's tax return, the year that you sell. And that's the reason we have 180 days, because they wanted the whole transaction on one tax return. The second piece to this is you have a 45-day identification period. That is absolutely the hardest part of this process, is you have to commit to a list by the 45th day, and typically it's given to the qualified intermediary. That's typically what we see, okay? It's a form we use, right? The client gives us a specific list by the 45th day. There are 3 rules. One is the 3 property rule. You can give us a list of 3 properties of any value. That's the one that most people use. They specify 3 addresses for us so we know what we're trying to buy, and that's what they give us. And those are their choices, right? Once we go past the 45th day. The second rule is called the 200% rule. If the list has 4 or more, then the list value cannot exceed 2 times what was sold. I use the example of a $500,000 sale. If we chose to turn in a list of 4 or more properties, those properties added up could not exceed $1 million. Where would somebody use this? We'll have clients sell a big $2 million warehouse, and their plan is to buy many smaller dollar condos to replace this. So if they sell at $2 million, they can give me $4 million worth of real estate on their list. Maybe it's 10 properties. All 10 added up don't exceed 4 million. They're good. They're still good to go. Third rule is called the 95% rule, which I rarely see. If the list has more than 3 and the value of the combined list exceeds 2 times what was sold, you have to buy 95% of the list. Functionally, you got to buy the whole list. I had a client sell a very large rental property in Northern Virginia, and he bought 15 rentals from a little old lady's estate in Richmond, Virginia. Well, it was definitely more than 3, because it was 15 properties, and all 15 added up was definitely more than 2 times what he sold, but he bought them all. It was a package deal. And so he used the 95% rule with us, okay? The actual language of the law is you get 180 days or the due date of the tax return. So as we come in on the end of the year, if somebody sells in December, we actually end their exchange, the due date of their tax return, April 15th. If they need more time, they file an extension, push out the due date of their tax return, and then they'll get their full 180 days. So that's something we deal with our clients at the end of the year. Most of our clients file extensions anyway, so they get their full 180 days. But the actual law says 180 days or the due date of the tax return, whichever comes first. Now, that 45-day is absolutely the hardest part of this process, right? Especially in today's market, it's nutso. And so once you give us that list and we go past the 45th day, that list cannot change. That's the hard part. They have to commit hard to a list by the 45th day. If the client does not give us a list at the 45th day, they say, listen, I'm not giving you a list at the 45th day, we're stopping the exchange and sending the client back their money on day 46. So that's the first moment to bail out of an exchange. The clock starts, money comes to us, we're sitting here, the clock is ticking. If they don't give us a list by day 45, midnight of the 45th day, we stop. They didn't tell us what to buy. We don't have a list, and we bail out, okay? If they do give us a list, they've committed us to use their money to buy from the list. Those are their choices all the way through 180 days. What we're seeing today in today's market is clients are writing contracts to buy stuff ahead of time. So usually what we see is they get a contract to sell, and it takes them 30, 45 days to for the buyer to show up with the money and do a closing. And in that window of time, they're out hustling and getting a contract on their replacement property. Our exchanges used to be 60 to 90 days. Somebody would close and it would, on their relinquished, when they're selling, and it would take them 60 to 90 days to go to closing on their replacement property. We're running 3 weeks now. So by the time somebody closes, in 3 weeks, they're already closing on their replacement property. And that very clearly tells me they've already got a contract to buy something even before they've gone to settlement on their relinquished property, okay? So the market is just moving like crazy. Can you get more time on these things? Well, very first extension was 9/11, and we had Isabel. The government then finally put an automated process in place. When FEMA declares a disaster, they post it on their website, and we go hunting for those notices. If you're impacted, and they usually carve the counties out that you're involved in, if you're impacted, you get to add 120 days to both the 45 and the 180. New York got a big one here recently, right, because of all the flooding up in New York. Texas got a big one because when they lost power, a year or so ago, the whole state of Texas got an extension. So we're watching those dates pretty closely. How much do you have to buy to not pay taxes, right? So let's go through that scenario. This is something we deal with all the time with clients because there's a lot of misconception about this. Here's my scenario again, right? We're selling $500,000 basis. We got 90 of mortgage, all that sort of stuff. This is a good slide. I got a sale price of $500,000. It's going to cost me 40 to get out. I'm down to that adjusted selling price. So remember this concept of you're continuing the investment to another property. It's worth 460 when you sell it. That's how much money you're getting out of that transaction before the debt payoff. You got to go buy another 460 worth of real estate to replace your investment. At closing, you're going to pay off the debts, right? So we're left with 370 of cash. That's what comes to us to be put into escrow. We turn around and buy another property worth 460. We apply the 370 of cash. Where will the rest of the money come from to buy this new 460 property? Most people go borrow it again, or they come out of their pocket for 90 grand. But just from a general concept, they're giving up 460 worth of real estate, and then they still own 460 worth of real estate, and all the money is back in. Nothing really changed for them financially, but the address. So the machinations on this is always people are going up in value, they're adding more money, which is perfectly fine, or they're coming down in value and they're causing some boot, some gain is coming out of the transaction. But just as a general concept, to not have a tax bill, you're looking to replace the full value of the real estate, right? And put all the money back in. What we run into with clients is they think all they got to do is reinvest the cash, because that's what they see online is, hey, all you got to do is reinvest the proceeds. If it was a cash deal, yeah, you got to reinvest the proceeds. But most clients have debt on their rental properties. So the proceeds are the money coming from the buyer, not the proceeds you get after paying off your debt. So we wrestle with clients a lot on that question because that's a big misconception out there. All you have to do is reinvest the cash or reinvest the profit. Doesn't work that way, okay? To defer all the gain, polling question. Sorry.
Caught you there. I'm going to go ahead and launch the second polling question, give you a break for water or something like that, Bill.
Yep.
So polling question 2, to defer all gain, you must A, replace the value of the investment and reinvest all proceeds. B, only reinvest the cash proceeds. Or C, only reinvest the gain. We'll give a few moments for the folks at home to ring in with their responses. Alrighty, we've got about 80% of folks responding. We'll give a few more moments for the last bit. Alrighty, I'm going to close out the poll now. I'll share with the results with everybody. It says the majority with 57% said A, to defer all gain, you must replace the value of the investment and reinvest all proceeds. 36% said only reinvest the gain. Did you want to clarify that?
I'm going to have to go back and do that slide again.
All right, Bill, off to you.
All right, off we go. Let's do the exchange, right? So we know how much, we know what kind of real estate we can swap. We kind of have a feel for a tax bill. If we don't do this, we know we can exchange into real estate, and we know the value we need to cover. Let's do the exchange. We're going to follow the safe harbor from the government. We do everything in the safe harbor the way the government told us to do it. Okay, you're safe if you follow these rules. You got to have intent to do an exchange, form and documentation, control the money, like-kind properties, and time limits. We talked about who is this qualified intermediary, right? But who's disqualified? So anybody who's got agency with the client is disqualified. Typically, we deal a lot with the realtors, and they have agency with the client, so they cannot play the role of qualified intermediary. What I do bump into is attorneys, right? Sometimes the attorney is doing the closing. Typically, around here, Maryland, Virginia, DC, the closing company does not really have agency. They represent the transaction. So they can also play QI if they want to, because there's no agency created there. But let's say it's an attorney and he helped the attorney help the client do a will or open a business or something to that effect and created agency, then they're disqualified. So this is not about who can be a QI, it's about who cannot be. So this is IRS logic, right? I'm a qualified intermediary because I'm not disqualified. If you want your neighbor Bob to be the qualified intermediary, go ahead and do it, right? Just hope Bob knows what the heck he's doing, right? So it's kind of fascinating. Anybody can be the QI as long as there's no agency there, right? Because agent is the client. All right, let's talk about process for a minute. This is a normal sales and settlement process, and I've alluded to that already. We get started when there's a contract to sell, because you don't need us until the client sells the property, right? And normally there's that delay between 30, 45 days between contract signing to sell the property and closing. And that's when we jump in and do our paperwork. Almost everything we need is in that contract. It's got the price, it's got the address, all that stuff is there. We're going to quickly create an exchange agreement and an assignment of contract. If you remember from previous slides, we get assigned into the deal. We must notify everybody of the assignment. It's a piece of paper, there's a notice, and then we send you guys settlement instructions. Hey, this is part of an exchange. Here's where we need you to wire the money, and please deed the property from our client to the buyer. As just sort of business practice, we ask you to mark up the settlement statement to reflect an exchange, but it's not a requirement, okay? It's just business practice how we do that. Mostly it's for the poor CPA. When he gets the transaction, he can see that there's an exchange in the middle of this thing, okay? And the flow of the money. Once closing happens, the money comes to escrow. We're dealing with the client on the 45-day exercise. They find something new, get it under contract. I got to get my hands on that contract so I know what we're buying with the money. I'm checking the list. I create an assignment, single piece of paper. I'm stepping into the client's shoes to be the buyer instead of the client. And then I send you guys settlement instructions. Hey, this thing is now part of an exchange. Here's the money I'm holding. I'm going to send it to you for closing. The client's bringing the rest of the money, cash, mortgage, whatever we got to do to close this thing. And here's my notice of assignment, right? So then it's done. So fundamentally, it looks like a sale and a purchase, and I'm adding an extra layer to this. It's not rocket science what we're doing, okay, to create the exchange of the old property for a new property. Let's talk about title for a minute. This is something we run into all the time. This is all about taxes. So the current tax owner that owns the property, that files the tax return on the property, that's my exchanger, right? This is about taxes. I got to have the same taxpayer that sells, got to be the same taxpayer that buys. Everything gets reported on that same tax return for the current owner. Okay, so it's let's say Bill Horan sells, it's got to be Bill Horan that buys on the buy side, and my social security number's got to own the property. Bill Horan and Kathy, my wife, We both made money. We both got to replace our investment on the buy side. There's a couple of exceptions in there. A single member, single owner LLC. Bill Horan sells individually. Bill Horan creates an LLC and Bill is the sole member. That's okay, because that's my own little business. It uses my social security number to file taxes. So it's a disregarded entity. Same with a revocable trust. Bill Horan individually sells, but Bill Horan, trustee of Bill's revocable trust, and I'm the beneficiary, then that's still okay. That is a disregarded entity. Not an irrevocable trust, that's a different animal, but a revocable trust is perfectly fine. We see them all the time. Also, a Delaware statutory trust is okay. So the government has green lighted the purchase into a Delaware statutory trust is okay as replacement property or relinquished property. It's real estate. So I don't know if you guys are seeing those transactions, but we see them on larger commercial property transactions. Also, the purchase of a single member LLC as replacement property is okay. Bill Horan sells. Bill sees a condo that is owned by an LLC, and let's say there's 3 doctors that are the members. I can buy all of the doctors' membership interest. I buy all 3 of their membership interests, and I become the sole member of the LLC that owns the real estate, and that's okay in an exchange because my tax ID number sold. My tax ID number now is the sole owner of the LLC that is on title to the real estate. Why would somebody do that? Why would somebody buy the company instead of the real estate itself? We see this more often in other states where transfer taxes are really, really high. We don't see it that much around here. Maryland's got a $1 million cap on the transfer of an LLC that owns real estate. Otherwise, you owe transfer taxes anyway. DC's got any transfer of an LLC that owns real estate you owe transfer taxes, right? So it depends on what state we're dealing with. There's different rules around the transfer of an LLC and whether it triggers transfer taxes or not. But just from a general exchange concept, it's okay to buy the company, become the sole member of the company that owns the real estate, and you're okay. Okay. All right. Now I talked about a bunch of stuff, right? I got about maybe 10, 15 minutes to go. Let's do it backwards. What's a reverse exchange? This is when the client needs to buy the new one ahead of time. The normal sequence is sell, pass through the QI, and buy. A couple of rules. You cannot exchange into something you already own. So I mentioned that earlier before. The client can't own the new one, sell something, and buy from themselves. It doesn't work. Improvements on real estate you already own are also not like kind. You can't sell something, do the exchange, buy something new, have us hold back some cash, and then buy a new kitchen to be put on your own new property. Because we're buying a kitchen and you already own the property. That's not like kind. So the improvements added to a property that the client already owns is not part of the exchange, okay? These are not the easiest thing in the world to do. These are a little more complicated, right? Remember, the basic law is sell and buy. So the government says, okay, we know people want to buy stuff ahead of time. So here's a way to do it. They give us a revenue procedure 2000-37. So we're following what the government told us to do. We create what's called an EAT, Exchange Accommodation Title Holder. And it has an agreement with a client called a QEAA. That's our agreement with the client. Fundamentally, the EAT's job is to force the sale and then a purchase. Let me walk you through a couple scenarios. This is where it comes from. Here's scenario number 1. The client has found the new property they want. That's the ideal purchase. If they don't close on it, they're going to lose it. They haven't sold their dumpy townhouse yet, right? That's the relinquished. It hasn't sold yet, but man, I got to close on the new one or it's going bye-bye. So what do? We engage an EAT, let the EAT step in and buy the new property for the client, Exchange Accommodation Title Holder. That's its job, is to hold the title. Straw man, third party, whatever you want to call it, to temporarily own that replacement property until the sale of the relinquished happens, and then they buy from the EAT that's holding the property. Okay, so it's a mechanism to grab control of the new one. The key is the client doesn't own it. Our holding company owns it, or a holding company owns it. It'll sit there and own it until somebody sells. The client has 180 days to do this as well. So our holding company could step in and buy something and wait 180 days for the client to sell and then buy. Most clients can sell because they dictate the price. They can force a sale if they need to. Now, where are the issues here? Well, as you can imagine, all kinds of issues here because you're putting a straw man in place, a temporary owner. Where's the money coming from ahead of time? What about transfer taxes? All those sorts of issues are part of what these things are. So these are not the simplest things in the world to do. Let me use an example. Let's say we're going to buy that replacement property. You're not using my money to step in and buy, so we got to come up with cash. I've got clients that have cash. They will loan us the money to buy the replacement property. So now we take title, 100% financed by the client. The relinquished property sells, buy from the holding company, and we pay the client back. So it's sort of a circle, if that's the right word to use. But that's a mechanism to do that, all right? You can also go in the other direction, so that we could force the sale of the relinquished property to the holding company. Because remember, the law says sell and then buy in that sequence. So the holding company can step in and buy the new one and wait, or we can force the sale of the relinquished property to the holding company. These are not the simplest, like I've said a couple of times now, to do. And depends on what state we're in, whether we can deal with these things and deal with transfer tax issues, right? But we do a bunch of these things each month too. Let me give you an example of an improvement exchange. So I'm selling a property at 460, and I found a beautiful beach house for 400, but it needs a pool. So if I do an exchange from 460 into 400, I'm going to expose 60,000 of my gain to taxes because I didn't replace my full investment, and I still need a pool. So I don't want to do that. So we'll let the EAT step in and buy the new one for us at 400 and add the pool. So while the EAT is holding the property, we can do improvements to it and get it up to 460. So then the exchange is 460 to 460. These have really got to be planned out well. I'm using the example of a pool because I can get that done in 180 days. But we have multiple of these improvement exchanges happening now underway, right? So that's what's called an improvement exchange. Sometimes you'll hear the term build to suit exchange. While the holding company is in ownership, you're adding value to the property to get the value up, okay? Oh, another question.
All righty, we're on our third poll question of the day. I will go ahead and launch it right now. A reverse exchange, A, is defined by the IRS. B, lets the investor buy a replacement before giving up the relinquished. Or C, is simple and easy. We'll go ahead and give a moment for everyone to ring in with their response. Got about 75% of the vote, so just waiting on the last few folks. Alrighty, I'm going to go ahead and close out the poll, and I'll share the responses with you. Looks like almost 80% said lets the investor buy a replacement before giving up the relinquished. That's great.
Off we go. Hey, how much more time do you want to give me?
We've got, I mean, we can go the full hour. We've got about 10 minutes here.
Okay.
I'm taking a look at the questions, and we don't have too many. We had one come in, but that can wait to the end.
Okay.
So I'd say, yeah, if you want to truncate some of your slides.
Yeah, let me just cover this stuff really quickly. So it's okay for somebody to go in with others on replacement property. You know, somebody sells something and they want to go in with others to replace. You don't have to buy the whole property yourself. You can go in with others. So typically what we see is what's called tenants in common. Somebody's taking property as tenants in common, or Delaware statutory trusts, okay? So all kinds of properties are sold this way. And the reason I'm bringing this up is you're going to see this in the market. It's a very large market space. Billions of dollars are being transferred this way. And these properties are packaged specifically for 1031 exchange clients. So somebody's selling. Let me back up a second here. The people that own all the investment real estate are all the old people. They bought property years ago. They got all the gain and they're tired. They don't want to be the landlord again on the next property. But they also don't like to pay taxes, right? They built up all this money and their wealth. That's what they're going to live on. And they don't want to give up that money by cashing out. So this whole market space has jumped up. It's not jumped up. It's been defined by the government how to do this stuff. And it's okay to go in with others to buy property. So there's companies out there we call sponsors. They own the real estate And most of them that we see today are what are called Delaware statutory trusts. So a Delaware statutory trust owns the real estate, and then they sell interests in that trust. You're buying a beneficial interest in a Delaware statutory trust, and the government has green lighted that transaction. You probably won't see it on your side because it's a paper transaction with the sponsor, but you'll see a sale, and then maybe you'll see somebody buying into a Delaware statutory trust or hear about it, okay? All kinds of properties are sold this way. Typically what we see are apartment kind of properties. We do not see a lot of hotels at this moment in time because demand on hotels is pretty weak. It'll come back here at some point. Same with shopping centers. We don't see a lot of those, but those are very popular. Mostly what we see are these standalone properties. We call them triple net properties. You see them around town, right? The Burger Kings, the Dollar General stores, all that sort of stuff. Very heavy into the Lowe's and the Home Depot, anything home improvement. Those are very active spaces at the moment. Same with medical, CVS's, Walgreens, very active. A lot of the warehousing stuff is going, you know, the Amazon warehouse stuff, all that stuff is very, very popular at this moment in time. The point is, there is if somebody doesn't want to do any work on the replacement property because they're tired, don't really want to have to be the landlord and deal with all those issues, there is a market space that you can buy into one of these properties. We're beginning to see second and third generations of these properties where these buildings are now selling and clients are doing more exchanges because the government has defined this as real estate and it's okay. I'll give you an example. I'm out here in Gainesville, Virginia. There's a big old BJ's box store that's nearby. That is owned by a Delaware statutory trust. And then individuals like you and I own pieces of that Delaware statutory trust. When that building sells, eventually it's going to sell, those clients can exchange out of that Delaware statutory trust and go buy more real estate. Some clients go back into more DSTs because they like it. And some clients, go buy their own real estate again. So it depends on what's going on with them. They have the right to go buy more real estate because it's considered real estate. Let me give you a couple ideas here, strategies. What do I see with clients? This is what we call the last great tax break. There's a strategy out there to eventually move in, convert an investment property to a primary. So let me give you an example. I own a couple of dumpy townhouses, kind of a pain in the rear end. I'm getting ready to retire. So I said, I'm going to trade those couple of townhouses rentals for a new beach house. And it's a beautiful beach house. It's got everything I ever wanted in it, right? Escalators, crow's nests, all that stuff. Media rooms, USB ports everywhere. It's set. I rent that beach house out for 2 years. So I went from investment to investment for 2 years. And then I've been in the DC area here a long time. So I sell my home. I put that money in my pocket. I don't have to pay taxes on my home sale. And I move into my beach house. I convert it to my investment property. There's no tax due. I've just changed the use of my investment property to personal use, and that's perfectly fine. So there's no taxes due. So that's a great strategy that my retirement place I already own. I've just converted it. And the sale of my home, I put all that money in my pocket. I didn't need to use the money from my home sale to go buy another home. I already own it. I just converted something. Okay, so that's a very common strategy. One of the things we get questioned on is when can I move in, right? I'm buying that beach house. Why can't I move in right away? Well, remember, by definition, exchange is business investment for business investment. So the government gave us a safe harbor when you can move in because the government knows people are doing this. On the sales side, which we don't normally see it on the sales side, you have to have treated that property as business investment for 2 years. What we normally see is on the buy side, when can I move in? On the buy side, you only have to rent the property for 14 days or more for each of the next 2 years. So after you close on it, you only have to rent it for 14 days each year for 2 years in a row. But you've got to keep your personal use down to 14 days or 10% of the days rented for the 2 years in a row. Okay. So what the government is doing is by causing some rental income, they cause a Schedule E, which is the form to report income and expenses. And on the Schedule E is personal use. So that's how they pick up the personal use on that replacement property. But after 2 years, you're safe. This is a safe harbor from the government. Okay, you can move into the property. Cool. When you go to sell that property, my plan will be to die there, right? That's my plan. I'm gonna, go move into my beach house, enjoy it, watch the sunsets, all that good stuff, and then I'm gonna pass away in that house. My plan is to let my son inherit it. Let's say it's $1 million when I pass away. He's going to inherit it at $1 million. He sells it the next day for $1 million. He has no gain. So my gain goes away when I pass away. You got to keep an eye on Congress. They're chasing this at this moment. So we'll know in a couple of months maybe as to where all this falls. That's called a step up in basis. But at this moment in time, the way the law is written is your gain basically goes away. The estate taxes, I think, is 11.6 million per person. It's a very high hurdle before anybody owes any taxes to the government when you pass property along. What happens if I got to move to the old folks' home, right? Now I'm hurting. I got to sell my beach house. When I go to sell that property, I can't take the full primary residence exclusion because they changed the law back in 2009. They're going to give me a haircut on the sale of that property. The premise is I've already owned it and now I've converted it to a primary. When I go to sell it, I'm not getting the full 250, $500,000 of exclusion because I've already owned the property. That's what they were after. So they made a change. So it's not as good as it used to be, but it's still good if it's a long-term plan. But if somebody's plan is just to jump in for a couple of years and then bail out, it's not as good as it used to be, okay? So just to summarize, you have to use a qualified intermediary to do an exchange, a delayed exchange. If two people are just swapping properties, you don't need a middleman, right? You don't need me in the middle of it. But if somebody's selling and buying, you gotta have a qualified intermediary. That's the safe harbor from the government so that the client isn't gaining. Even if it's 10 minutes in between, they sell at 10 o'clock, and then at 10:30 they buy the new one. You still got to have a middleman in there because there's 30 minutes in between transactions, right? And you got to make sure the QI is hired before closing. Critical thing. I hate that phone call. It's Monday morning. I get the call. Hey, I want to do an exchange. Okay, what's going on? I closed last week. Well, you don't own any real estate, so I can't help you because it's my job to do the transfer of the real estate. So I hate that phone call. Anyway. So typically what happens from an exchange standpoint is we get started usually from a referral. A lot of agents, a lot of you guys as title companies refer us, right? And then we jump in and drive and guide the client through the process. What I typically find is once the client understands what the rules are, the basic fundamental rules, then they're okay. That's what most people need. They just need where the bumpers are and how to proceed. Once they've got that, then they can proceed from there, all right? So I covered a lot in a very short period of time. Does anybody have any questions?
Thank you so much, Bill. We did have one question come through,
Sure.
and it's a good segue that you're just talking about your big takeaways there. And the question was, as a QI, what kind of fee structure do you collect, or what do you charge? What can they expect?
Yeah, so we charge $950 to trade one property for another. So if somebody's just selling one and buying another, it's a flat $950. We typically put that fee on the relinquished, the one they're selling. We add ourselves to closing, and you guys send us a check. That's typically the way we do it. If they're buying more properties, let's say they want to sell one and buy two, I'm going to add another $300 to the transaction because I'm going to go through another closing with you, move money, contracts, the whole shooting match. If I'm doing a reverse exchange, when I do it backwards, I start at $5,800. It's a much more complicated and specialized transaction. So when you're analyzing doing it backwards, you got to add that fee load to make sure it's feasible to do an exchange, to do a reverse, right? The overwhelming majority of what we do is normal, what we call forward exchanges. Somebody selling and moving forward to buy something.
And then we had another question here, and your presentation has been wonderful, and you threw a lot of information at everybody,
Right.
which is great, as we only have an hour to spend. But can they contact you directly for the slide materials and maybe follow up with you with any questions?
Absolutely, happy to do that, because the more you guys know, the more clients I get. So this is purely education.
Wonderful,
Absolutely
wonderful.
happy to help.
And your email address is right on the screen right now for folks
Sure
to do that. Just as a word as well, we will be uploading this presentation to the Security Title website. We have a library of videos, educational videos on topics such as 1031s, and we'll be happy to add your presentation as well.
Thank you.
At this time, Ron, was there any other send-off that you wanted to add to this before we conclude?
Yes, absolutely. Bill, we'd love to thank you for this informative presentation. We truly appreciate your expertise on the 1031 exchanges. We wish we would have had some more time for you, but as Anshi had mentioned, you could get a hold of Bill His information is on the screen. I'd also like to thank all the attendees as well. And on a separate note, Security Title will be hosting our next monthly webinar in November. We'll be sending out an email shortly regarding the next topic. So thank you all again, and I hope you will all attend in November. And once again, Bill, thank you so much. We really appreciate it.
Thank you for letting me do this. Appreciate it very much.
Thanks, everyone. Have a great day.